2nd of April, and we have just got through one of the most difficult quarters in markets since the GFC, or maybe even the 1987 crash for that matter. Now hopefully you found some of the information that the investment team and the Integro advisors have been sending in the last few weeks useful, but we also thought it would be good to do something a bit more personal, so we've prepared a quick video update on portfolios and markets. So what has been going on in markets, and how have the Integro portfolios been doing amidst all of this? Well, having started to fall in late February, markets continued to fall almost without pause until around the 23rd of March, and most markets were down around 30% from peaks in February to their lowest point. When all this kicked off, it was because markets began to appreciate what was happening in Italy, and we started to get a sense of what the human impact might be as this spread around the rest of the world. Soon after that, Italy had to impose lockdowns like China had previously, and it became apparent what kind of an economic impact that might have. Not just the disruption of supply chains, but for the demand side as well. Then in mid-March, credit markets began to seize up, as the finance world now started to worry about which companies might not be able to honour their debt commitments. However, in the last 10 days of March, governments and central banks started to work together, and they pretty much threw everything they had, making sure the economy would make it through, including the consumers. That meant markets rebounded by about 10 to 15% by the end of the month, but most markets were still down around 15 to 20%, which is a big fall. Now you've probably read far more about viruses than you thought you ever would, and we won't focus too much on that now, but rest assured we are following that closely, and we are constantly trying to assess how much markets have already priced in, or even whether at times they might have overreacted. Now we can't guarantee that's the case, now especially that markets have rebounded a bit, but at some point it will be the case, and it will present investment opportunities. In some areas this is already happening. Now it might sound a little too hard-headed to be thinking in those terms already, but the fact is we have to keep our focus on this. It's important that we don't overreact or react at the wrong time, as that is what can destroy wealth. Buying high when everything looks fine, selling low when everyone else is depressed, and then inevitably missing the upturn. And that's a really important thing to remember about modern investment markets. The internet means markets are really good at processing new information and very quickly project forwards. It also means information like, say, infections in Italy get instantly priced in, probably before you've read about it in the news. That's one of the reasons why markets moved so violently when we saw that news coming out of Italy, and people had really got their mind around what was happening there. Markets are the lightning rod for the collective thoughts of the world, which is sometimes called the wisdom of crowds. But on the other hand, markets being a representation of our collective self also means they can be driven by sentiment, and as people get more and more depressed, including fund managers I have to say, they can overreact. This means, as Churchill once said, the darkest hour is sometimes just before dawn. Just think about investments and popular sentiment when markets have performed really well in the past. In the early 80s, after the dismal 70s when interest rates were hitting 17 to 18%, or after the 9/11 terror attacks and the US recession of the early noughties, and after the GFC from around March 2009 when the real world was still reeling, markets started heading upwards. Markets always look forward. So how have we dealt with this confusing situation from an investment perspective, and what have we specifically done with the Integro portfolios? Well, we were pretty cautious coming into this, holding some cash just in case, some alternatives for diversification, and even some gold. We didn't know this was going to happen, but we thought markets were a bit expensive, and expensive markets are a bit like a bug looking for a windshield, another market saying. Then around the 10th of March, we got a bit more defensive by selling about 3 to 5% of equity exposure depending on the risk profile of the portfolio, keeping it in cash, bonds and a bit more gold, which was a good thing for a week or so. But then about that point, we felt markets were no longer that expensive, and while they could fall further, they could also turn around if things improved, which is what happened. Right now, we're still in a bit of a holding pattern, but there are areas of the world that are getting very cheap in our view, and that is where we're doing our homework. Overall, we remain about 8 to 13% defensive depending on the risk profile of the portfolio, so that does give us a bit of room for manoeuvre. Now, one of the areas we think is especially interesting is emerging markets, and one of the managers you will have exposure to as an Integro client, Trinetta Investment Management, has already started putting money back into the markets by investing in some stocks that have fallen a great deal, but which the manager thinks will make it through the crisis. This includes an airline, would you believe? Anyway, he's a braver man than I, but that's why we have specialists like this on the front line. So how have diversified portfolios performed when all is said and done? As I said, peak to trough for markets was about 30% so far, but for a diversified portfolio which holds other assets, such as bonds and cash, and some of the alternatives I mentioned, that would have ended up being more around 5 to 15% down, or maybe a little bit less than that for the month of March. To put that in perspective, we often say that markets go up by the stairs and down by the lift. So this is not that unusual given we also have up years of 5 to 15% from time to time. So is there anything you can do as an investor? Well, first of all, remember that these are general observations that don't take into account your personal circumstances. So please do discuss this with your advisor if you have further questions. But one thing I would say is how important it is to stick to your plan. If you're not sure what that plan is though, again, go and have a chat with one of our advisors. Otherwise, stay well and please don't worry too much about your money, as you've probably got enough on your mind at the moment, and we are very much on the case. Look forward to talking soon.